What if I told you that one of the worst performing funds in the entire closed-end fund universe, a fund whose share price has declined nearly 95% since it launched, that has cut its distributions 13 times, that has been forced to do reverse stock splits twice just to avoid becoming a penny fund, has actually been a profitable investment for anyone who held it and reinvested their dividends? Not barely profitable. A $10,000 investment turned into $75,000 over 30 years, a 654% total return, from what most people would look at and immediately call a disaster. That sounds impossible. It is not. And understanding exactly why it happened is one of the most useful things any income investor can know, because it completely changes how you think about high-yield investing, about unrealized losses, and about what your real options are when an investment goes wrong. We have been told that high-dividend investments are risky, that NAV erosion and unsustainable payouts make them dangerous compared to growth stocks or index funds. But when you actually run the numbers on some of the worst performers in every high-yield category, mortgage REITs, covered call ETFs, closed-end funds, the results challenge almost everything most people assume. If you are building a high-income portfolio and want honest analysis like this every week, hit subscribe. I post real breakdowns on high-yield investing consistently, and I do not sugarcoat the trade-offs. And before we get into the data, quick question for the comments. Have you ever held a high-yield investment that was underwater on share price but kept paying distributions? And if so, did you hold and reinvest, or did you sell at a loss? Drop your experience below. I reply to every single comment, and this audience's real stories are genuinely useful to share. Let us start with the fund I described at the open, the Cornerstone Strategic Investment Fund, ticker CLM. On paper, this fund looks like everything you're supposed to avoid. Since launching, the share price has declined nearly 95%. It has suffered 13 distribution cuts over the past 2 decades, going from 33 cents per share down to 12.15 cents, a 63% reduction in payout. It has performed 2 reverse stock splits, both 1 for 4, just to prevent the share price from falling into penny stock territory. The current yield is over 19%, which sounds attractive until you account for all those cuts. By every conventional metric, this is a terrible investment. So what actually happened to a $10,000 investment made in August 1995 with all distributions reinvested? An average annual return of 6.76%. The $10,000 grew to approximately $75,000, total return of 654% over 30 years. Now the more interesting test. What if you made the single worst possible timing decision, buying at the all-time high on December 23, 1999, the absolute peak? Even then, even with the worst possible entry point, reinvesting distributions produced an average annual return of 4.26% over the following 26 years. The investment was underwater for a long time, but the dividend snowball eventually pulled it into positive territory. That is the mechanism worth understanding. Even as the share price kept falling and distributions kept getting cut, the reinvested dividends were buying more shares at lower prices. More shares generating more distributions, generating more shares. The compounding never stopped working, even as the headline numbers looked terrible. The second example is Two Harbors Investment Corporation, a mortgage REIT. Between its IPO and the pandemic, Two Harbors was mostly flat on share price while delivering a very high dividend yield. When COVID hit, it suffered catastrophic portfolio losses from which it never recovered. Today, the share price is down over 77% from its highs. The dividend dropped from $2 per share to just 34 cents, a decline of over 80%. To any investor, this looks like a nightmare. But an investor who held through the entire period and reinvested all distributions still generated an average annual return of 3.18% over 16 years. That is not a great return. It underperforms an index fund, but it is positive. It is a gain on an investment that lost 77% of its value. The third example is the most surprising and probably the most controversial because it involves YieldMax ETFs. MSTY is YieldMax's MicroStrategy Option Income Fund. MSTY itself is down 85% in just over 2 years. It underwent a 1-for-5 reverse stock split. And yet, an investor who held from launch and reinvested every single distribution still generated an average annual return of 16.87%. That comes surprisingly close to matching the S&P 500 over the same period. If they had sold earlier, they would have beaten the market significantly. I want to be clear. This is not an argument for buying MSTY with the expectation of strong long-term returns. These funds were designed for income, not capital compounding. NAV erosion is a genuine structural problem in covered call ETFs built on volatile single stocks. The numbers look positive because of the initial high yield and MicroStrategy's bull run. But the broader principle stands, and it applies across the entire high-yield universe. Reinvested distributions buy more shares at lower prices. The yield on each new share purchased increases as the price falls. The dividend snowball accelerates precisely because the investment is declining. Think about GoPro, a popular growth stock that crashed from $70 to under $1. What are the odds someone who bought at the peak ever sees a positive return? Essentially zero. There is no mechanism working in their favor while they wait. The only outcome is hope for a recovery that may never come. Or Xerox, hyped in the late 90s, crashed, never recovered. An investor who bought at the peak has no dividend engine working in the background, just a stagnant loss. The high-yield investor in a declining position has something different. As long as distributions flow and are reinvested, the machine keeps running. Now the honest trade-offs. The first is opportunity cost. A 3.18% annual return is poor compared to what an index fund delivered. While waiting for a losing high-yield investment to turn positive, that capital could be deployed elsewhere for better returns. This is a legitimate argument. The second is that reinvesting distributions is incompatible with living off dividend income. You cannot simultaneously reinvest and spend those same distributions. The goal is never to be in a position where this strategy becomes necessary. Buy carefully, diversify. Avoid obvious yield traps. The snowball is a rescue mechanism. But the mechanism exists. Even some of the worst performers generated positive total returns. That is a piece of context rarely included in the criticism of high-yield investing. Do you think the dividend snowball concept makes high-yield investments meaningfully safer, or does opportunity cost outweigh the benefit? Drop your take below. Hit subscribe for weekly honest high-yield content. Let us keep building something real.